Okay. What is going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we are going to be doing some stock analysis for Netflix stock mainly because they're in the news today. They just bought Warner Brothers, Discovery TV, including HBO Max, in a roughly $72 billion cash and stock deal. I want to say it came out to $82 billion altogether, but either way, it's a lot of money. It's actually, I was telling my friend that just a couple years ago when I was looking at different stocks and different mergers and acquisitions, like a 30 billion, $40 billion acquisition, those would be denied a lot of times because it was, they were pretty much arguing that it was turning into a monopoly. So I'm kind of surprised to see that this deal just went through for $80 billion and there was no problems with that and nobody prevented this from happening. So I think that part's interesting, but either way, Netflix is just a monster company and it's been a monster stock specifically since 2022. And I am kind of disappointed in myself because when this stock went all the way down, I bought this stock and made a position. And within like a week or two, I got scared and I sold out because I thought, okay, maybe Netflix is going to be a loser, because the problem at the time was it was their first quarter where they had lost a number of subscribers. And so I don't know. That was a pretty big mistake on my part. If I would have kept those shares from back in May of 2022, I would have made, at least five, six times on my money in the matter of the last 3 years. So I'm kind of disappointed with myself for that one because I didn't hold on to those shares, but it doesn't matter now. So pretty much the stock topped out at $132 a share. Now we're down to 100. So a pretty nice discount. What is that? That's about 30% off, a little bit less than 30% off. Let's see, what have we done in the last 3 months? Yeah, so we're probably down 25% or something. And if we look at this company's valuation, we can see that right now we are at this stock has traded very rich in the past, which is actually a great lesson for anybody who is a newer investor, meaning like less than 5 years, or if you're somebody who is kind of a risky or gambling style investor where you don't pay attention to valuation, you don't think it's important. And let's say if you're bullish on Tesla stock right now, you probably fall into that category. Or if you think Palantir or Tesla is not overvalued right now, then this is specifically for you because you go back to the last couple of years. This is a perfect example. Netflix has been a monster company, right? It's been a innovative, disruptive company, incredible growth and incredible hype back in 2015, 2016. The stock was over 400 times earnings. And even though they continue to grow, look what happened to the PE. It's come it trended down practically for what, 6 years? Pretty much 6, 7 years maybe. And it bottomed in 2022. It went all the way down to 15 times earnings, which just shows you that at the bottom of a bear market, even the best of best stocks that traded at over 400 times earnings can go down to the most ridiculously cheap valuations that looks like they're priced to go out of business or something. That was June, summer of 2022, 15 times earnings. Since then, we've gotten back to more respectable, reasonable valuations where it likes to trade at like 40, 45 times earnings now, which is not cheap by any means, but Netflix, it demands that premium for a reason. I think this company has very strong pricing power and which that's going to absolutely, lead them to continue growing their sales and net income over the next however many years. And it should be pretty easy for them, really, as long as they keep up with solid content and stuff like they're doing now with this acquisition. Then this company can continue growing, continue raising prices with inflation, and continue a trading at a strong multiple. You look at Costco. Costco is no high growth company, but they have pricing power and they maintain that high premium on the stock. So, anyways, Netflix trades 40 to 50 times earnings typically, let's say 40 times earnings. So, in this bear market of 22, if you got this stock anywhere under, let's say between 15 and 30 times earnings, you got a very good deal on the stock, right? Because now we trade in the 40s. So just keep in mind though, no matter how great the company is, the valuation can come down, and 100 times, 200 times earnings like Tesla and Palantir are at right now are not sustainable. And as you can see, even though Netflix stock went all the way up, for over a year or two, right? It traded at these crazy valuations. It will come down in the following years. So just, consider that you're kind of playing with fire when you are buying anywhere near those valuations. So let's get down to, is Netflix stock a buy right now? Well, as you can see, it's pretty much in the average zone right now, right? And the next thing I would want to look at is, how is their growth going? So sales the last 5 years have averaged 12, 13%, okay? And we could even, what's it been the last 2 years? 15%. So that's actually, wow, that's actually kind of surprising. So their 2 year revenue growth has actually averaged higher than their 5 year revenue growth. That's interesting. So I would say it's probably going to stay at around four. It could even stay at 45, maybe even 50 times earnings, really. Let's go down to net income here. Look at that. Let's go to the last 5 years. Look at that drop off and then that increase there with the net income. See, so this is when the stock dropped, right? Because the net income did not look good. It flatlined for over a year, and then it actually declined in 2022, 2023. And then it wasn't until mid 2023 they started really improving net income. Look at that, $4 billion up to over 10. That's more than a 2x just in the last 2 to 3 years. That's incredible for net income growth. Incredible. Same thing with free cash flow. Outstanding. $9 billion of free cash flow now, up from negative just 3 years ago. It's really crazy how much they've grown those numbers. Shares outstanding, they're buying back shares. That's good. So, and again, what's the, let's see, what's the growth here for this? 5 years. Look at that. So again, because that decline there, that set those numbers back. That's why the 5 years is only 30%. The 2 years, 51%. I don't think they're going to be doing 50% net income growth over the next couple of years. I don't think that's realistic. What do analysts have them doing? Analysts have 15%, then 13% revenue growth, and then so what is that? That's 0.5 out of 2 is 25%. So 25%, then 2.5, then it's going to slow down to probably 20%. And eventually they're going to get to 15% probably the following year. So, and that's where I think that multiple will probably come down. Potentially. I could see it maybe stay. Right now it's at 32 forward times. It's really not a bad buy, really. I would say if the market comes down, like the index funds come down and stuff, I could see that Netflix coming down to, maybe an $85 stock or maybe even a $75 stock. But if that doesn't happen, I think we could be, if this market keeps trending up in 2026, Netflix, I think this stock will go back up because, so here, let's say the stock keeps trading at 40 times earnings, right? 40 times is like almost conservative. It could trade at 45 times earnings. 45 times this year's EPS puts the stock at $112, okay? So not much higher than where we're at now. Then we go into next year, and that puts the stock at 145. See, that's what, a 45% return you would make over the next year. That's a good risk to reward. That I kind of want to say it's a buy. I don't like that they have that much debt there. That's not good, but I think they can honestly handle it. What's $5 billion difference, and they're doing, yeah, they make that in the matter of what, a couple months. In a couple months they could pay off that debt, so I'm not worried about that. Now they spent $80 billion, but how much is it in cash and stock? Now they have Game of Thrones, DC, and Harry Potter. Yeah, see, with 2 to 3 billion on projected cost synergies. Okay, so this is gonna help. This is gonna help them a lot. This is gonna bring. I literally just subscribed to, what was it, Peacock, or I think, yeah, I subscribed to Peacock, and they have Harry Potter and stuff on there. So I think this is gonna be a good move for the company. And I think these numbers are looking good. If I were to say, let's see here, I mean, they're not going to have, I don't think they're going to have trouble getting up to $15 billion in net income over the next couple of years. So 15 times 45. Yeah, I think this stock is going to go up like at least 40% over the next like 3 years easily. Maybe even less, maybe even 2 years, honestly. I think this stock is pretty close to a buy. It's kind of in a weird place right now because it looks like I mean, this could be the bottom, but it looks like it hasn't found its bottom yet exactly. So a lot of times when they downtrend like that, they'll stall out at a certain price and it'll sit there for like a month or a couple months. So it could do that. It could come down to like $90 or something and then sit there for a couple months. But it also could just turn around pretty quick here. So it's sometimes it's hard to judge. So it did like if I were to buy now, I wouldn't make it a big position probably. I would start small just in case it did fall, and then I'd buy more. But again, you look at these numbers here. We're at 43 times earnings. I mean, you just run the numbers of they're going to do $3.2 of EPS next year, and the forward PE is on the low side right now. The stock is like it's on the low side. So, but what I wanted to see was if they're paying $80 billion, the only thing with I mean that as much as that's going to bring in sales and stuff, that is how many subscribers do they have? 300 million is insane. That's insane. That's almost the entire population of the United States. My only problem is that's practically if they say that this net income, that would be 8 years worth of net income, and they're in debt on top of that. So now their debt just went to $85 billion. You take off the cash off of that, we're looking at 75. It's probably like 70. Yeah, no, it'd be 70. Yeah, it'd be like $70 billion of debt now they're gonna owe. So let's say this net income keeps going up, which is not out of the question. Let's say they're doing $12 billion and $13 billion in net income. They could probably get to 12 and 13 billion next year, the year and the year after. You're looking at 6+ years. You're looking at 6 years to pay that off, which is not the end of the world, really. I mean, these things like Game of Thrones and Harry Potter, that's going to make money for decades and decades, right? The deal expected to close after a Warner spinoff in late 26 would massively expand Netflix IP library for the US. There we go. That's what I was talking about. It faces significant US and EU antitrust scrutiny and includes a $6 billion breakup fee if Netflix walks away. Okay. So interesting. So it is what it is. Either way, this reminds me of Adobe when they tried to buy Figma a couple years ago for $26 billion or whatever. It's the same thing where the debt doesn't look good and investors think they're overpaying, but it also is growing the company. So I would say if I had to pick buy or not buy on this, I would pick buy. I would probably buy this. I might make a position in this. I mean, again, the only thing is if we do have a correction, like I'm kind of expecting to have the next couple months here, then I could see the stock coming down to, who knows, 70, $80. It could come down to maybe $80 or something, and then I would lose money. So that's why I would keep the position small right now. But with the way this is looking, this valuation is not, that's a pretty good deal now. And we're talking at probably 42 times earnings. This is right. I don't know. Again, look what happens when you have a bear market, though. This could easily get cut in half. That valuation could get cut in half. So actually, the stock could probably go to like $50 or $60, honestly, if it was a rough bear market. So that's kind of the way I see this. I'm kind of tempted to make a position, but I'm not sure yet. So we will see. Let me know what you guys think down below, and I will see you in the next video.